Good evening, everybody, and welcome to the Merlin.AI Unleash the Wizard Meetup for Alpha Droid folks and SectorSurfer folks. As you can tell on the Meetup announcement and on this first slide here, there's a new portfolio set of strategies coming out called the Bull Rider Bear Fighter, and that's what we'll be mostly talking about in the second half of the presentation. So while others are coming in, we'll just do a few little logistics here. So because there's so many people on the other end, if you got the dogs barking and the doors closing, we should go with the microphones shut off on all the other side. However, there is the chat feature, and if you've got questions along the way, please input them into the chat feature and then go into the questions at the end. And we are getting more formal these days, and so for respect to our attorneys, I must say, do not base any investment decisions solely upon materials in this presentation. Neither Some Growth Strategies nor I are a registered investment advisor or broker-dealer. The presentation is for educational purposes only and is not an offer to buy or sell securities. This information is only educational in nature and should not be construed as investment advice, as it is not provided in view of the individual circumstances of any particular individual. Investing in securities is speculative, and you may lose some or all of the money that you invest. Past results of any particular trading system are not a guarantee of future performance. Always consult with a registered investment advisor or a licensed stockbroker before investing. Okay, so today the plan is we'll go through a brief summary of our base technology, how artificial intelligence will help, a summary of how Merlin.AI works, the Merlin.AI strategies and portfolios, using Merlin.AI with SectorSurfer and AlphaDroid, why AI is missing in action on Wall Street, and then we'll go live online to import Merlins Magic. Okay, logistically, just to remember, we're talking about Merlin.AI, and Merlin.AI is an official URL. So you can just go to your URL line and type in Merlin.AI, and it will take you right to this page that you see here. It tells you a little bit about the technology here and provides launch points for finding the Merlin.AI strategies and portfolios. Very soon there will be more listed here, but we're on the way. So now behind all of this lies all of the math and technology, all the methods outlined in this book, Conquering the 7 Faces of Risk. As we say along the top here, see how a Royal Society Fellow, a National Medal of Science winner, and a trio of Nobel laureates laid the foundation that will forever change the art and science of momentum investing. Now these guys all had their brilliant little pieces. I just kind of sewed them together to make what we have here today. But it's all based on really good stuff. Merlin.AI builds on and does not have to rediscover other existing knowledge. What does that mean? It doesn't have to reinvent all of this from scratch, all of the SectorSurfer and AlphaDroid things. SectorSurfer and AlphaDroid are very similar services. The user interface and some of the features for the AlphaDroid advisors are just different than what individuals prefer to have. But as you can see, the charts are very, very similar and alike. So it doesn't have to reinvent all of this from scratch. It builds on top of SectorSurfer and AlphaDroid, all of the good things that you see about selecting only the best trend leader each month and going one at a time with these sectors through time, builds a strong equity curve that avoids the losers that are down in the ditch, the bad sectors, and also keeps us out of the market crashes. And it moves on this risk versus return rainbow chart here, the white being the S&P 500 and the yellow being the strategy. We want to move up and to the left, higher return, lower risk. So Merlin.AI is not going to reinvent this. Momentum in market data, Merlin.AI accepts this. It was then later confirmed by these guys, Eugene Fama, Nobel Prize winner 2013, and his partner. And we're not going to try to reconfirm this with AI. Most importantly of all is Claude Shannon. And he proved in a 1946 paper at Bell Labs that the signal-to-noise ratio controls the probability of making the right decision. So seeing even a little bit of the road ahead changes everything. It's about clearing away the noise. And I think most of you have some kind of experience about being in, for example, a noisy sports bar. And for you guys, if you're sitting there with your sweet one, and there's all the noise in the background, and she's whispering to you the honeydew list, and you don't get that honeydew list right, you know if you're in trouble. Well, it's the same thing in the market. You think you're looking at messages coming to you from market data, but if it's filled with clattery noise, then you may react upon noise as opposed to on a true momentum-based signal. So this is really important. Your number one job in all of investing is to improve the signal to noise ratio. The number two job is to improve the signal to noise ratio. And that's also the number three job. If you don't do these, you're just playing with random data. So always keep that in mind. Next, and Merlin.AI also accepts that which was developed by John Van Vleck. Once you determine that signal to noise ratio is important, then you have to go solve the problem. How do I actually make more signal come out and less noise come through? You need tools, and one of them is matched filter theory. And what it's designed to do is to be the optimum shape filter for accepting the momentum signal and rejecting the noise signal. Unfortunately, academia and most of the professionals still use a simple moving average, which is typically either 6 months or 1 year equal weighted across and then drops to zero. It's like, what did this come down from heaven, from God, from Allah or something, that the universe says equally weighted for exactly 1 year is going to be the optimum? It's like a square box of saying to go high speed down the freeway, you can take this Model A Ford and be highly efficient. Neither of those are true. When you apply the math of Dr. Van Vleck, you find that the optimum filter is more like this second order exponential moving average, just as though the smooth curve of a good sports car also goes down the freeway better. But we're not going to reinvent that in Merlin.AI. And likewise, to help us remove common mode noise is differential signal processing. And this is a pretty simple concept. It's one where as time goes on in the market, the market's bouncing up and down. You can see all of these guys here have a common little bounce. This is common mode market noise. And if you're just looking at one thing at a time, like let's say XLY, one of the consumer discretionary ETFs, and it's bouncing along, are you actually looking at the XLY signal, the momentum signal for XLY, or is it just filled with noise from whatever's going on in the market? Perhaps Trump is tweeting and it's going up and down, but they're all going up and down. So to remove that noise, that's why we examine up to a dozen ticker symbols in parallel. They're compared with one another, and the act of comparison is a subtraction act. This compared to that is, what's the difference? And by taking the difference, you remove from them the common bumps. And in fact, you can see the curves down at the bottom. This is your filtered momentum signal. And we want to own only the trend leader. But we're not going to ask Merlin.AI to reinvent this. We're asking it to accept this. And that includes the concept whereby over time, so here's 10 years of time, and here's a whole bunch of sectors plotted with their monthly average returns, rolling returns, right next to the S&P 500, which is in white. And as you would expect, the momentum signal, or the average monthly return signal of the S&P 500 should typically lie right in the middle of all the sectors, because of course it is built out of all of the sectors. And so if you're going to beat the S&P 500, if that's your goal, then it would seem to make sense that surfing from sector to sector, and only the trend leader is the methodology for beating the S&P 500. And we're not going to ask Merlin.AI to reinvent that either. And we're further going to just have Merlin.AI accept this, Storm Guard Armor. So this is knowing whether the market is safe risk on versus risk off. We're not going to ask Merlyn.AI to figure out that bear markets are very different from bull markets, and they ought to be treated differently. And to treat them differently, you must detect when you're transitioning from one to the other quite well. And StormGuard Armor does this quite well using 3 different indications. As most of you are familiar, there's a standard price trend indication. Then there's a value sentiment. This is the playing at the highs and lows of the market. What are those people doing? And the market momentum. The market momentum is kind of heavily influenced by institutional volume. And these 3 things together are looking like looking at an elephant in not just one leg. If one leg is wiggling a little bit, is he just twitching, or is he starting to walk? You know, if he's starting to walk, it helps to look at 2 other legs as well. The more pieces of information you have, the more likely you are to get the signal correct. Provided, of course, that your new information is not more noisy than what you already have. So we're not going to ask Merlin to reinvent this either. In fact, StormGuard Armor is a very interesting thing. I have to show you this chart. This chart is from a brochure that we're taking with us to a couple of the trade shows coming up. I've had some advisors say when you actually show this kind of a chart of the value of StormGuard Armor relative to the S&P 500, it's hard for people to unsee this. So what we're showing here is, of course, S&P 500 in white since 1996, and then in pink is exiting out of the S&P 500 into cash when you have the death cross crossover, and that's the 50-day moving average of the S&P 500 crossing over the 200-day. And you know, it makes things a bit safer, but doesn't give you that much overall time because it does get whipsawed more often than not. In orange is the StormGuard Armor moving to and from a money market. And as you can see, it does much better. And better than that is don't just sit on your hands, but actually own something like treasuries or bonds during this period. Make a little money. Don't just sit on your hands. And these are concepts that Merlin.AI is not being asked to figure out and reinvent. And we'll come back to why I keep saying that eventually along the way. Okay, so here we are. We have these guys along the top, and these guys got us to here, and that's pretty good. But is there more? Well, yes, there is. What about selection bias? And if we look at the strategy on the left, so on the strategy on the left, we have a nice set of 12 ETFs. Most of them are the original 9 ETFs from the SPDR sectors. And there's an extra 1 or 2 thrown in like SPDR Gold and SPDR XLB, I believe is the, yeah, well that's the materials. I was looking for XHB. Yeah, we have XRT in here, that's retail. And there's one other odd guy in it, doesn't matter. Anyway, so we have a nice performance. And the interesting thing about this problem of hindsight selection bias is that in some views of the problem, SectorSurfer doesn't have the problem. So the problem exists when you make a strategy, and I take up to 12 ticker symbols and I put it into it, and I show it to my good buddy, financial professional, and he says, well, Scott, that looks very nice, but when did you choose those funds? And I say, well, I chose them today. Thank you very much. Isn't it a beautiful strategy? And he says, well, yes, but that's cheating. You see, you chose those funds with the vision of hindsight. Hindsight's 20/20. You left out things that were losers and only put in things that were winners. And that's where you can run into trouble. Now, interestingly, with the SPDR ETFs, the original SPDR ETFs, 9 of them, which grew to 10 and such, the 9 original were built on the premise of they want to cover the whole economy. And they use definitions for how to cover it based on what the economists have been saying for 100 years in all the academic papers and such. This is how you divide up the economy, and there's actual standards for it, how you divide it up. And they modeled the Spider 9 just exactly for that. So if indeed you include every one of them, then you can't be removing things that in fact were bad. You've included everything. So that's one method to overcome hindsight selection bias, is to just include everything. But it's easy to do something else. And one of those things, for example, in here we have, where is it, XLV, right there. XLV is a healthcare ETF. And what have they done with that? Well, they've divided it. Now we have XPH, I forget what some of the things are. They divided it into pharmaceuticals, into healthcare equipment, into biotechnology, and healthcare service providers. And so now there's 4 of those. And pretty much every other sector has been subdivided into subsectors as well. And so now if you had 9 or 10 of these things divided by 4, now all of a sudden you got 40 of these things, and it becomes kind of an unwieldable thing. And it is pretty easy to build strategies and just take a narrow subsector. Right now people might notice that healthcare equipment is booming along fairly well. And maybe you go and make a strategy with healthcare equipment. And maybe biotech is, the pharmaceuticals are sputtering a little here and there because the politicians want to rein in the prices charged for the drugs. So right now, if you just pay attention to IHI, your medical devices ETF, and don't put the other thing in, then you might commit the sin of hindsight selection bias. You take something out that isn't doing anything for you today, and it comes back to bite you later because you didn't include some of everything. And as an example, the chart on the right, it could be that if you said somewhere along the way, well, healthcare and energy, who needs that? It's not doing anything for me recently, so you could be doing that along here. What the heck do I need those for? But then because they're missing, compared to this guy over here that has all these things, you see they just don't perform. You get flat tires in the future when you do not include some of everything. Okay, so we have a problem. We have, what is it now, 1,800 ETFs. By one way of counting, some would count a lot more. So what's Merlin.AI going to do? Well, Merlin.AI is a genetic algorithm layered on top of a strategy. So it's like chocolate frosting on top of the good old stuff. But why do we want to do that? We want to do it to evolve its set of funds each month to remove hindsight selection bias. And why? It's to achieve better future performance. We don't want those flat tires. And we don't even want the criticism of somebody saying, well, you have hindsight selection bias. Your thing's no good. You want to build something, a strategy that's not only going to hold up, but actually, when you hear from friends, they don't kick you in the shins and tell you it's full of garbage. So to remove hindsight selection bias, there is another way. And that means we need to have fund selection be automated. And for some of you with the need to have your hands on the controls and the wheels and stuff like this, if we automate fund selection, then it's basically you must submit to a higher power. And of course that's Merlin. So Merlin is the genetic algorithm. So here we go. So what is a genetic algorithm and what is artificial intelligence? So AI definition, according to Wikipedia, is that AI is the ability of a machine to perceive its environment and take actions to maximize its chance of success at some goal. And we want to apply that to investments. So can a machine perceive its environment, like sector rotation, bull and bear markets, and take action to maximize returns and minimize risk? We say yes. Interestingly, if you go to Wikipedia and look up artificial intelligence algorithms, you get this list of approximately 200 different types of algorithms. And mostly these days, we don't hear about any of these things except for neural networks and machine learning. Well, I guess all of these are a type of machine learning, but neural networks. Excuse me. So how will some growth use AI to perceive the environment and take action to maximize success? Well, it turns out we already had two types of artificial intelligence within already. Most of you remember that we have the forward walk progressive tuning algorithm inside to adapt the tuning of the momentum filters over time. The market can change its characteristics, or you can suddenly have new funds that begin later in time than other funds, and they change the character of the investment strategy. So forward walk progressive tuning allows for adaptation. Excuse me. Second one is StormGuard Armor. StormGuard Armor employs fuzzy logic to evaluate a composite of 12 measures of the market's character to determine current investment safety. So we're looking at not only the three main components I talked to you about before, but there are questions about, well, is it high or is it low? Is it accelerating upward or downward? And so by the time you get done with all of these little things and combinations of them, you've got a dozen ways that you then have to bring back together to one answer. All of these little things are pieces of the information, and that is a form of a form of AI as well. And finally, we get on to the new thing. So what is Merlin going to do? Well, I might like to call this, relative to forward walk progressive tuning up here, forward walk progressive picking. So with forward walk progressive tuning, every so often we would take a look at the information that has gone before us and look to see how we could retune the algorithm based on the prior information. And then we would walk forward in time using those settings. So we're always walking forward out of so-called out-of-sample data and progressively tuning as we move through time. And it seems that's a good idea for the picking of the funds as well. So hence, Merlyn.AI might be called forward walk progressive picking. And it's going to use a genetic algorithm to evolve a set of candidate funds and their momentum strategies to eradicate the remnants of hindsight selection bias. So this is the application that was built and was first debuted about a year ago. And it goes through and does exactly that. So in a genetic algorithm, it's much like having a population of people. You need a population of strategies that are a little differently configured, and you move them through time, and some of them have better performance than others, and then you mutate them and do crossovers with them, which I'll describe, just like you do biologically. And so when you employ a genetic algorithm, and we call it forward walk progressive picking, it is funds picked with in-sample data, that means in the past, but used with out-of-sample data, that means the future. So if we're sitting right in line with these numbers here, we can use information back here to say what we can pick, but then we have to use it going forward for some period of time, and then pause again, and then maybe we can use this other information. So one thing I want to be clear about, that I've had some questions, and I have to say that I struggled with this at one time too. The term hindsight selection bias is kind of strange, in that if I say I'm sitting right here and I can use this information, well, isn't that hindsight? Well, it is a form of hindsight, but what is really meant by the term is the phrase you've all heard, which is hindsight is 20/20 vision. So that means like Monday morning quarterbacking. Once the plays have run and you knew where all the people were, then you can, of course, say, well, the quarterback should have thrown over here or over there. That's hindsight. You know where people ended up going, and it's that hindsight. You can't use that kind of hindsight in choosing your team and making your plan. So let's say it's July. July is coming up. If you choose your team and make your plan on June 30th, you can use everything June 30th and before to make your plan and choose your team, and then you run through July, and whatever you get, you get. However, if you're sitting there on August 1st and you say, what would have been the best thing to do? Let me run all the optimizer stuff, and it says, the best thing to do would have been to have this team and to have these time constants for the filters. That's using the hindsight of what actually happened in July to decide what to do with July. So always remember, hindsight is 20/20. It means when you pick your team, you can't know something about the period of time you're going to judge. So if you're going to run through July, you have to make all of your decisions. Pick your team, pick your plan on June 30th, not on August 1st. So that's the difference. So under the hood, so how our genetic algorithm works, consider this analogy to humans. So in humans, we have genetic evolution, we have mutations and crossovers of the genes. Everybody got schooled in that pretty well. But let's think about an analogy to a strategy. So in our strategies, you remember with a good sector rotation strategy, you include all of the sectors. So let's say there's an analogy between the finance sector and your right arm, lower arm, and the energy sector is associated with that, and health and tech and transport and materials, etc. All these body parts are like other sectors. And so if we do some sort of mutation or crossover thing, you don't end up putting a leg in place of an arm, something like that. And mutation doesn't do that either. You get a little bigger, fatter, stronger, weaker, different color, whatever it might be. There's slight variations to let's say this finance arm, but it doesn't become a leg. Okay, so when we do that, then if we say, okay, here we got these body parts, and here's a spreadsheet that's read in by the application, and it looks, and it has, in this case, 12 different categories, each of them corresponding to one of these guys over here. And in these categories, for example, of financial, here's all your financial ETFs. So we might have XLF right here, right now, but at some time as we go along and we mutate or do crossovers, we might find that VFH or one of these other guys actually performs better, and he gets swapped in. So over time, we're going to allow these as mutations for the category, and we'll control how and when we do the mutations and the crossovers, which I'll show you in a second. So one might ask, where do you get these gene options from? So I'd like to call these are my different genes. I'm going to mutate these things. This gene makes the material part of our body, and that makes the industrial part of our body, and these are the gene options. So where they came from is simply going to ETF.com, and you can sort things out in a spreadsheet, scab it off of their site, and what I did is I sorted them by assets under management, because we want to have the big things, because we're all paranoid that there won't be enough trading volume. And I also looked at things to exclude some things. Some of these things, such as this is all technology, it looks like. Well, some of these are technology for foreign countries, or maybe 2X or something like that. So all the ones that I wanted to include that were strictly U.S. sectors, I put in the spreadsheet where if I put in the little X, then it would add the ticker symbol. So So now we got a list of ticker symbols, and that's what ended up going in these guys here. So that's where those came from. So here's how the genetic algorithm works. Let's say we have a population of 12 strategies. So let's say we're going to do a sector rotation strategy with the genetic algorithm. So we got 12 strategies that we're going to have. And each month, we're going to have mutant and crossover children made. So you can see these children, like this guy's got a dark arm, this guy's got a dark head, this guy's got an orange head and a dark body. And so you can see there's been a little changes to these things. So you're going to change little parts to be slightly different. And then you measure these things, and only children with better fitness than their parents survive and replace the parent. So let's say this guy here. So this guy here, he comes down here and he's got this this hand, which is a gray hand. And well, I guess I didn't move all these up here exactly. But if the guy with the gray hand doesn't perform better than the parent, then this child strategy dies and does not continue on. And instead the parent continues as it was, as the strongest one. But if making that change to the slightly different financial ETF made it perform better, and better in fitness terms for us is going to mean some combination of risk and return, or risk-adjusted return. So if the child performs better, then we keep that variation. And then we want to have lots of variation in here. And you can think of interesting things like the bubonic plague. The bubonic plague took out a lot of people. I think it took out, I forget whether it was 40 or 60% of England at one time. And you might say, well, why didn't they all die? Well, it's because some of them had genes from sometime, who knows when, maybe 1 million years ago, that were still resident in their body, and maybe they weren't truly important anymore, or not very often. But having a variety of people or variety of strategies in your population, if something radically changes, that suddenly requires a gray arm. Here's a guy with a gray arm, and the gray arm is going to, maybe that's, I guess that was finance and other thing. So if suddenly the gray financial thing is the strongest thing as compared to, let's say, technology or healthcare or something like that, and the gray one is the strongest of the strong, we want to have that with us already, meaning we don't want to have to take months and months to evolve it in. We want to have a good chance that gray arm is already being expressed in one of the members of the population. So we want to try to keep some diversity. So that's part of how the genetic algorithm is going to work. And so when I show you this spreadsheet here, this is like a history of the evolution. So you see dates along the left-hand column here. And this is my little code for how a evolution happened, a mutation happened. So M stands for a mutation, and the C stands for a crossover. And I guess I didn't talk about a crossover up here. But a crossover, let's just hit that right away. So mutation is we're just going to, change out one of these financial ETFs for another directly. But on this guy here, we can start talking about strategy 6 and get all hot about this guy has a weak arm, but there's somebody else he mates with over here that has something else. Instead of going to the pool of 8 possibilities, you just find the cute one over here or the strong one over here that seems to be doing good, and say, hey, let's have a kid with a gray arm. And so it can also change just like people do with crossover by sharing of genes. So yes, strategy 6. Don't get too hot about it. Anyway, so here we have little codes that say we had some mutations and some crossovers, And there's another little code in here that indicates where we have to do some kind of a repair when something got a little too wild and reckless. And I can see what that is over here. So XBI is a biotechnology ETF. And biotechnology can get too wicked and too noisy and just disrupt the party. And so he was booted out, and BBH happened to know that in this zone, XBI did get very wild, and BBH was a calmer version of biotech. So these are the codes for what happened, so you can see. But you can see as time goes on, in a strategy that has symbol 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, it starts out with just a couple of things, and as time goes on, it mutates. And you know, for reasons of what's going on in the market or what it's being paired with, you just get these changes that change over time. So I want to compare here now, and you just kind of saw it, but didn't really get what you saw. This is evolution for history for member number 1. So the enforcement of diversity, if I click this thing, come on, there we go, it went to member number 6. So this is a different thing. So I'll see if I can go back and, oops, let's see, here we go, 1 and 6, 1 and 6. So you can see they're doing different things. And that's a good thing, actually. So on this application here, in this zone in the middle, this is blown up here, then as you will see shortly, here's our members of this strategy. It's a sector rotation strategy, and here are the selections made by the 12 different members. The member strategy is just like a SectorSurfer or AlphaDroid strategy. It's got up to 12 ticker symbols, and they're each picking a winner, okay? And then each month, these guys are put into another strategy. For those who are familiar, it's like a strategy of strategies. So these go up to yet one more contest to see which one of these is the strongest. And he ends up in this slot here, which says pick number 1. And pick number 1 is the best. We also pick or record pick number 2 and pick number 3 for prosperity. Okay, so this is the application, and this is actually a video 300 times in time lapse. So these things take about an hour to run from 2004 to present. So if I click on this, we should get a video that goes across, and you can see the equity curve building. You can see the rolling return and risk. You can see all of the ticker symbols changing, the monthly picks. And let's do that one more time because it just went so fast. But this is mutation and strategy sex right before your own eyes. A little too quick for some. You'd like to have it last longer, but there we go. That's how it works. Okay, so now what we want to do then is actually do that for divergence strategies. So the next step is to have, for example, this strategy called Style Box Fox. You can't zoom in and see this here. You can with the PDF. But basically, this is all of the like large cap, small cap, value growth kind of stuff. That's the style box where you got 9 boxes that describe that major set of indices. And so you're always looking for the best one of growth, value, small cap, medium cap, large cap. And of course, we don't go off the cliff with a bear market. We employ Storm Guard armor to pick us up and save us during these periods. The next one is factor faves. And a factor in the parlance of academics and industry folks is something like the size of something, or value is a factor, or earnings is a factor. So all of these kinds of things, including dividends and international, are all factors that the academic study to determine is there something special in any of these classes that can help us invest. And of course, the mutual fund people and the ETF people said, yeah, we can make special mutual funds and ETFs. We can have value funds and growth funds and small cap and large cap, and everybody can buy into these things thinking they're knowing which one's going to do best. So why not just have an algorithm pick who is the strongest leader at the time? Not surprisingly, this is very, very similar to Stylebox because large cap, small cap, growth, and value are some of the major constituents down here, and the other constituents apparently don't contribute a lot. Also in the portfolio is one I call global domination. So these are world regions, and the world regions operate a little bit differently than some of the U.S. sectors and large indices. So those are good. And then over here is finally what we call sector nectar. So this is just sector rotation. And all of these colored things are the different categories and the ETFs that live in them as options. Now, one of the things I say on the SectorSurfer side of the house is that when you build a portfolio of things, it's best to build a portfolio of divergent sectors, because you know that these global ETFs, they're going to wiggle a little bit differently than U.S. sectors, which are going to wiggle a little differently than something that's just style box stuff. And by having things that wiggle over the short term and the longer term a little bit differently, then you can end up with even less wiggling because they are uncorrelated. So the final step of building a portfolio out of divergent strategies is a good thing for yet reducing the risk a little bit more. So here is that Merlins Magic 100-0 portfolio made with those percentages that we had talked about. And you can see the storm guard armor kicks in during the blue periods here. So this is a strategy that over time has averaged 25% average return, CAGR. And these charts were made for a partner of ours in the advisor space called Riskalyze, and they have a risk number that they measure. And according to that formula, this has a risk number of 20, and the scale goes from 1 to 100. And typically a bond fund, an aggregate bond fund like AGG, typically have a risk number of about 22. So this is pretty good stuff. And for those advisors that might be in the crowd, I know we have a few, then a real important thing to take away from the 2-year rolling return chart is that the strategy holds up above the S&P 500. I one time asked one of our partners, who was a financial advisor, I said, Brian, hey, you know, while I'm writing this book here, I'm looking at all these different measures of risk. For advisors, what really is the most important risk? And he says, well, it's the risk of possibly getting fired by the client. And I was a little surprised by that. But the point he was making is advisors, and I'll just say it in the way I'd like to phrase that, but advisors suffer from the problem of having the wirehouses like Wells Fargo or TD Ameritrade or any of these guys put together the quarterly reports for all the clients, and when they do that, all of the returns are measured against the S&P 500. And so the clients get those and they look at the S&P 500 versus their thing, and they see it, you know, departing and not doing at least as well. They're on the phone, and if it's not doing as well for long enough, that strategy is fired, and the advisor might get fired with it. And that's very interesting and troublesome. That means that if you want to do a value strategy or a growth strategy or a dividend strategy or any of these things, they tend to be a little bit different than the S&P 500, and they'll wander back and forth. And so if you give a client something that's a little different than the S&P 500, you're taking a risk that you're going to end up getting fired, because there will come a time when it is likely to not do as well, and then you're toast. And so this is one of the reasons why advisors are driven to give their clients things that are very close to the S&P 500. Of course, one way to beat that rap is to use momentum to just boot out the sectors that are down in the ditch and don't go over the cliff. So usually you get risk reduction in modern portfolio theory through dilution. Dilution meaning you have these risky old stocks and they go up and down too much, so let's throw in some bonds, and then they'll only go down half as much and only up half as much. So that's dilution. We're going to put more and more stocks in there until it's smooth enough for you. Much better than risk dilution is risk avoidance, and that's what SectorSurfer and sector rotation do. They say, let's not even go there, and in fact, let's change the whole asset class thing and get out of equities and get into bonds and treasuries and that sort of thing. So the ability to do that and avoid the sectors in the ditch and the bear markets is what lifts you up a little bit and will keep you from getting fired by the client. Okay, so as we've come along, then we've had a very interesting and good video made by a video maker that really surprised me, and I have to show it to you. Some of you have seen it, but it really talks about the whole Merlin artificial intelligence thing very well. And by the way, on the left, if you want to see that video yourself sometime later, or one of our other videos that summarizes the technology, or there's a deep Merlin thing from last year, just go to Google and search for YouTube Scott Judds, and you will see these videos, and so they're easy to check out. So with this, I'm going to see if I got it all lined up here. And if I click this, then...
As investment managers, what we think we know and even our past experiences and intuition can place limits on our profits and consistency. This is what we know as hindsight bias, and it affects everyone. Merlyn.AI is a tool that can eliminate hindsight bias and give you more profitable and more consistent results. Merlin uses genetic algorithms to create and consistently maintain the best strategies. Using SectorSurfer and AlphaDroid's data and knowledge, it intelligently analyzes and selects from hundreds of ETFs in a specified portfolio and assembles them like DNA into 12 parent members. It then selects the best members and crosses and mutates them together into even better child members, using only the best performing fund's DNA from each. Merlin then selects the best ETF from that group. Each month, the AI will continue to evolve each set, replacing each member with better and better members, which will thrive in the current market environment. Although you don't ever have to worry about operating it, here's a quick overview of how Merlin works. It starts with a base portfolio of ETFs and then populates the initial strategy members with the best qualified of those ETFs. After analyzing them, it creates mutations and crossovers of each. The whole mutation and crossover process is controlled by specified settings like generation offspring, mutant diversity, suitability and behavior, as well as selection bias and member fitness. Once all the best members are selected, the AI then selects the best ETF choice within the overall portfolio to create a strategy of strategies. Merlin.AI automatically adjusts filters and thresholds and leverages StormGuard armor and bear market strategies. Merlin continually repeats this process, making for greater consistency, better returns, and dramatically less risk than manual management. Merlin.AI, the smartest investment tool you'll ever use. Contact us today to learn more.
Let's see, so next. There we go. So let's talk about ETF tax efficiency. What's behind it all is there is a thing called an exchange in kind that is a non-taxable event. And it was originally designed for moving accounts to another brokerage. So let's say you had a mutual fund over at Fidelity and you wanted to move it over to Schwab. So if you sold the mutual fund, then you would pay taxes on whatever the capital gains were. And so the act of trying to move it to another brokerage became a taxable event. And apparently all the brokerages said, this is really bad. We know we can steal more accounts from the other guys because we're better than the other guys. And so they all agreed that they should lobby and get that to be a non-taxable event. And when that came about, then what happens then is you own this mutual fund and it's, has its 100 stocks in it or whatever it has in it. And the brokerage you're moving from converts that to shares of stock. And those shares of stock, which used to be embedded in the mutual fund of which you owned a share, are now your own shares of stock. And so it's like an electronic piece of paper. You don't really get the piece of paper anymore, but you get your mitts on them and you can drag those stocks over to the other brokerage and put them in there and avoid taxes because of this exchange in kind. Well, the smart skis that decided to invent ETFs decided they could make use of this. So a market maker exchanges a basket of stocks for ETF shares. So here's this guy who's going to do all the action of buying and selling. So we are second parties to this. We don't ever really do anything with the ETF company. We do things with ETF shares, and the ETF shares are only dealt with by the market makers. So the market maker goes to the ETF company and says, I'd like to buy 100,000 ETF shares so I can provide liquidity in the market today, kind sir. And so they do that by looking up and seeing what is the exact composition of an ETF share, and then they buy 100,000 shares worth of that in individual stocks, and they turn over the stocks to the ETF company, and the ETF company gives them 100,000 shares of the ETF. Okay, so now the ETF is actually represented by this unitary basket. And time goes on and things happen, and maybe a year later you come back and you say, I want to sell this ETF. But during that time, the composition of the basket has changed. But as far as you're concerned, you're just taking this ETF and, well, in fact, you're only really exchanging the ETF with the market makers, but the market maker doesn't incur any kind of capital gains because he's taking that in-kind exchange back, and he does that without having capital gains on it. He just gets the in-kind exchange, and so that gets passed on to you. So if you could take all of the SectorSurfer and AlphaDroid stuff of Merlin and wrap all those trades up in an ETF, you could, well, go from short-term capital gains to long-term capital gains. So that's a big thing. And so, yes, here's the other half. So the market makers return the ETF shares to the company and receive an in-kind exchange for the current basket of stocks. So this is the big deal for the tax efficiency. Okay, so another important ETF thing is the ETF liquidity myth. And a lot of people believe that if something has very low volume like this guy here, that in one day, if you had this kind of volume, you would blast the living bejesus out of it. And in fact, this is an exchange made for the ETF iPay. When Merlin says go exchange, we have advisors and individuals that actually did this. This is Merlin activity right here. And plotted on the chart here, we have iPay next to AXIC, which I believe is the NASDAQ. And you notice that these are marching in lockstep. And there was no perceivable change here. And the whole reason is the liquidity is not determined by the number of shares of ETFs or the average volume of the ETF. It's determined by the underlying stocks. So it's the purpose of the market maker to provide that liquidity. And if you want to suddenly in one day do 2.5 million shares when the average volume is that, you better believe those market makers were busy doing those exchanges. And it didn't dent anything because the liquidity is determined by the underlying thing. And there's a lot of underlying stuff. Now we'll get down to the meat. So here's some news. And I'll preface that in what I'm going to say, there's some things I can say and I can't say. Some Growth Strategies is to SectorSurfer and Alpha Droid a signal provider. And a signal provider is the same thing as an index provider for the big boys. And signal providers, index providers provide trade signals without specific advice to any individuals. And so it's just general trade signals. And we, Some Growth Strategies, decided we could be an index provider and joined with some other folks to start a new company called Merlin.AI Corporation in January. And we raised $2.5 million, and the purpose of Merlin.AI is to exclusively license from Some Growth Strategies the Merlin technology and create and market Merlin ETFs. And that's a very complicated structure. So associated with Merlin.AI is not only our end, but Merlin.AI is not going to really create any ETFs themselves, but use second-party or third-party suppliers. And so one supplier is, there's always a public calculator and publisher of the index. That's a third party that keeps honest the reporting and gets it to the Bloomberg terminals and stuff like that. And the meat of the work, though, is done by a partner. Some of you have probably heard of Alpha Architect. Alpha Architect has a couple of ETFs of their own, and they're going to act as a so-called white label ETF provider. And so they're connected to all these other services. In the ETF business, then you've got like the New York Stock Exchange attached, but there's the market maker who's going between Alpha Architect and the New York Stock Exchange, and the U.S. Bank is the custodian of the different funds and holding the stocks to get traded back and forth. Of course, there's Quasar, it's a so-called distributor that makes sure everything is according to what FINRA says, and there's the SEC, and there's half a dozen other boxes I left off here. So this is just an informational report that says that this is something that we've done. We've partnered with some other investors to create Merlin.AI for that purpose. And the index that we are starting with is called Bull Rider, Bear Fighter. And while we, as the index provider, come out talk about securities, we can talk about the index all day long. So the index is made up just like a Merlin's Magic. However, there's twice as many guys underneath. And instead of trying to read all the small print there, let's just look at it this way. So the Bull Rider Bear Fighter Index is going to have two bond strategies in it at 10% weighting, a style box, a factors, a global regions, a countries, so that's individual countries, and then a pair of sector strategies. So there'll be eight ETFs picked by this index each month. And what does that look like? So not too surprisingly, it looks very similar to the equity curve for the Merlins Magic. It's actually just a tiny bit lower because we've included some bond funds, two bond strategies within there. But otherwise, its shape looks very, very similar. So that's the bull rider, bear fighter. So this index already exists. It's not quite everywhere yet. But here, for example, you can see on this company selectives, we have the MAI, that stands for Merlin.AI. Merlin MAI Bull Rider Bear Fighter Index is now published on Selective. That's a German publisher. And very shortly, we'll have our own MAI indexes site up, probably within the week. I need to get it done before 2 trade shows coming up. So MAI indexes will be a service of some growth strategies, just like SectorSurfer is a service of some growth strategies, and AlphaDrive is a service of some growth strategies. MAI indexes will formally create and publish indexes that can be used in more formal places than SectorSurfer and AlphaDrive sites. So to keep up with where this is all going, all you have to do is Google Merlin.AI, bull-rider, bear-fighter, and you'll see what's going on. Right now there's not a whole lot on here, but you do see one interesting thing up on the top, which you're free to go look and read and get a little more information. It also talks in here about Alpha Architect, Merlin.AI's partner, and here's the meeting for tonight. It's listed there too. So to keep up on when something's going to happen, you can check here, but you'll also know more automatically as a subscriber to SectorSurfer or AlphaDroid when something formally happens. Okay, so getting towards almost the last topic, why are AI funds on the Wall Street missing in action? And so I went to etfdb.com, or I guess it was just etf.com, and searched for AI ETFs as a classification. And I found that all but 2 of them only had to do with companies that use robotics or use AI in manufacturing, but only 2 of them actually used it for actually picking stocks. And that was AIEQ and AIIQ. And so AIEQ is by Equibot, the company, and it says it's using IBM Watson and neural networks to do its job. So AIEQ is in green, NASDAQ is in light blue, and the S&P 500, those are their official ticker symbols for the indexes, is in purple. And so far, AIEQ has failed to impress. They started out very quickly with some assets under management. They were up to 240 million at one point, but I think the enthusiasm is passing. I would say they've broken their picks. They have a little sister fund, AIIQ International, that was started 9 months later, and apparently by the time they started that, it was already aware, people were already aware that AIEQ was not maybe doing so well, and they never did get very many assets under management for it. It also broke their pick. Another fund called Buzz was used to find patterns in Twitter messages. And after a year, so it's the one in green here, it failed to distinguish itself from just another piece of the market. And it is now a dead fund. It died in March. It broke its pick. And then we have BlackRock. They have 7 AI-powered sector ETFs. So when you really look into them, what they're really doing is only looking at the quarterly and annual reports with the AI and trying to figure out better which stocks should belong in which funds. So it's like a purification test. But they're not using anything to actually pick something to buy or sell in a particular month or quarter or anything. Just a purification test. And apparently investors aren't impressed. After 18 months, even though they got like $50 billion in many of the other sector ETFs, they average only 7 million in each of these guys. It's like they don't, the investors say why. So they haven't really used AI to actually pick anything. So I think because they've got a big army of guys working on this in San Francisco, they must have broken their pick on actually picking stocks. So why are they missing on Wall Street? I think there's a couple of reasons. One, they're trying to solve too many simultaneous problems. And when you try to do that, then the algorithm gets confused. It doesn't know what factor it's trying to focus on, or maybe it doesn't even know it has 5 things that it has to go solve. So, for example, with signal-to-noise ratio, it first has to discover that it's important, then it has to go discover some solutions. Then it has to discover that there is such a thing called a bear market, and that it's a different problem. And then you need, so after you've discovered that, then you have to go and detect how and when it arrives and what to do when you get there. So that's a real problem. Another problem with neural networks, it seems that the biggest problem I've heard from 2 experts in the field who have looked at people doing algorithms to buy and sell with neural networks is there's a big problem with the future leaking into the past. You have a very complex matrix of neural networks with little signals being passed back and forth between them. And if the future leaks into the past, then you have this hindsight bias problem. You know something about the future and you think it's going to be great. And in fact, we happen to know that the fellow who is running Equibot really believed he'd have a huge return, quarter by quarter, but it's not working out that way in real time. So perhaps he had future leaking into the past. So in any case, the field is wide open, and we hope to be able to take something there ourselves. So in the last little portion here, I want to just show you, okay, we can click on that as we had said, and it takes us right to the information. You can scroll down. You click this guy here, he's actually a big 45-minute presentation from last August. And so far we have just the same strategies and portfolios that we had here last week. But by next week, we'll have another 8 strategies and another 2 more portfolios on here. And if you want to import those into your own account, let's see, does it get into it here? No, it doesn't get into it here. But if you wanted to, for example, put the sector nectar guy in, you can click that blue thing and it'll tell you all about how this thing is built and what's in it. And at the bottom, how and what to do to put it together. Similarly, for the portfolio, like Merlins Magic, there's one other step. Now, here it's talking about you want to have a portfolio of home run hitters. So these are your divergent strategies. Each one of them is a home run hitter, not hitting exactly at the same time. And so the portfolio smooths out their performance. And down here, it tells you about how to create a portfolio of strategies. So we're going to go do this right now. It'll only take just a moment. Let's see. So I think let's see. Oh yeah, already have it up here. So sector rotation, my strategies. So I have an account here that I opened up. And so how you do this? We'll make a Merlins Magic portfolio here really quick. So you click on the blue S, which is select a strategy. And normally some of these other boxes are clicked for including premium strategies or free strategies. But if you say just show me the master strategies, well, I also have MER up there. So here's all the master strategies of which these are. And a master strategy means that you can't edit it. Only Merlin can edit it. It's too complex. So it's not like a regular strategy. It's a master strategy. And if we want to see only the Merlin ones, if I type MER up in this box up here, then only MER things come up. So let's put in the factors, use selected, and then come back here and put the global domination in. And then we'll put in sector nectar. And then we'll add file box Fox, yes. And Merlin's Magic did not have the bonds in it because Merlin's Magic was trying to be a little more aggressive. So now if you look at any of these guys like Septermber, we can click the chart and we see we got the chart up there showing what it's doing, and it's got its buy and sell history and all that good stuff, close. So now to create a portfolio, the instructions say if you've been given a name with P colon, capital P colon, and we'll put it in Merlin's Magic, we'll call it that. And then you have to pick ticker symbols here that are going to refer to these guys up here. And the secret code is, if you're going to put strategy number 2 in there, you put S2 for strategy 2. And then you want to put an allocation weight. And you can see it's suggesting some here. And what it does is it takes all the allocation weights, adds them up, and then divides it out by the percentage to get what you're after. And I just happen to remember that factor faves is a 15 percenter. Let's see, so 15. What we're going to do is approximately, if I, oops, so I do -7, use select. And oops, and then on the second one, I'll do number 3. And what's number 3? That's global domination. We had 25%, 40 point. I need to start from the other one to do my thinking right, so I get this to come out right. I know that Septermber is 45% and it gets a weight of 9. Okay, so let's start with there. Septermber. So S4-9. Okay. So there's a 5 we multiply. So global domination gets 25%. So S3 S3-5, and the others get 15, so then they're S2-3. In fact, I can put in a comma there, S5-3. Put that in there. And then when I get this thing up here, it has our thing with the 45, 15, 25, and 15% there. And if we do this guy here, then it looks just like the chart we looked at earlier. So that's how you put a Merlins Magic portfolio together in your own account very quickly. And just as a reminder, it says someplace that strategies, they have a cost, but portfolios make no decisions. They're just a reporting tool. Portfolios are always free. You can put together combinations to see what they would do and behave like together without any extra cost. And so I believe that then takes us to the end of our lollipop. There's the end of the lollipop. So now I'm going to take a look at questions that have built up. And start at the first one. So Mike says, sound is good. Any news that you can share on the ETF you were planning to launch? This is where I'm in a little bit in a box. There's things that are public information, but I'm not allowed to sell or promote ETFs. But the very soon, I'm going to just leave it at that because I'm not sure if I can actually say a date. But you can look at the public documents and find information there. But you will find something communicated to you when just for being a member of the Meetup and or SectorSurfer and Alpha Droid, you will automatically know when something hits the street. Another one from Mike. Several Merlin strategies use very liquid ETFs. Would you please consider creating a Merlin strategy using only liquid securities? ETFs are not inherently illiquid because the liquidity is based on the stocks and securities beneath them. And any ETF liquidity issue will be taken care of by rules that are allowed by the traders that actually implement the ETF. For example, let's say the index picks 8 ETFs. If you look into the prospectus, any prospectus, the prospectus will basically say something like the manager of the ETF, that's the guys who are doing the trading, will implement the ETF holding at least 90% of the stocks or equities selected by the index, but it reserves the right to use the last 10% in a way that it feels can help it best match the performance of the index. So this is a little important loophole or trapdoor that they have. For one, they've got a real problem in that index providers will, just like SectorSurfer and Alpha Dried and you guys, our charts say basically you get the news this morning. When you wake up, you see the trade alert there, and the strategies that we post will assume that you have made the trade exactly at the close of the subsequent market day. But nobody much trades exactly at the end of the day, because either you're busy and you can't quite do it, so you do it when you can, or you can do it exactly, but you're too smart for that and think you can find a better time to trade during that day. So hardly anybody actually matches what SectorSurfer and Alpha Droid do. And for the index, for an ETF, it's even harder. They may try really hard to buy and sell everything right at the close of the day that the index changes, but they can't because it's a huge amount of money. So they have to start trading sometime before the end of the day, might extend into the next day. They might run into little anomalies. And so they have that little 10% fudge factor that allows them to do anything the hell they want to try to get it to match the index. And this is not a new problem for us. There are other funds of funds. And let's just say, don't worry about illiquid ETFs within the index. It's not a problem. Okay, so now next question. Every momentum strategy requires a look-back period. What look-back period do you use for your ETF selections? The look-back period, so let's be specific here. Let me, let's see, do I need to get a visual prop? No. Okay, so for any particular period in time, let's just say this line right here is the particular day that it is right now. And when we come up to the end of the month, the sequence of things is that each of the 12 member strategies. So remember, we have a sector rotation strategy, a country strategy, et cetera, et cetera. For, let's say, the country strategy, that is a genetic algorithm strategy. So that means it's going to have a population. So it really has 12 underlying strategies. And when we come up to month end, then we have to pick, we have to determine whether there's a new pick or not. And so just before we make the pick, we do the evolution. So we go through each of the strategies one by one, and there's little rules that determine, and for example, the rule for all of these is for each of these 12 underlying guys, each month, we will pick 2 of the ETFs in a set of 12, and we will try to do a modification and see if that improves. And then we will take 1 of the 12 ETFs in its candidate list, and we will let it try to commingle or interchange with a strategy that has higher performance among the 12. So it's going to mate, if you will, with the cutest other strategy and see if it can get some good stuff in there like that. So for all 12 of these, this happens. This is the first thing that happens on the last trading day of the month. After all of those 12 have been mutated or crossed over, then they all have their own pick using this new combination. That new set of 12 then goes into a strategy, an SOS, a strategy of strategies, and then is judged again next to one another, and the best pick comes out of there. So what then happens in this, to answer your question, the look back period would be the length of the momentum filter. And interestingly, the momentum filter for each of the 12 underlying members of the strategy, each of the 12 in the population does its own thing. Remember, we got this progressive tuning thing. Each one of these guys is doing his own progressive tuning thing. So one of them might be looking back 100 days and, in a rounded off type second order exponential moving average kind of filter thing, not a rectangular simple moving average, but the DEMA. And so one might be 100 days, one might be 33, it could be, any of those could be anything. And then when you take the winners from each of those 12, put them into the strategy of strategies, it too does, runs the strategy over all time with its best forward walk progressive tuning parameters, and who knows what it's going to pick. So all of them pick the optimum for it, and I have no idea what they are. They're all optimizing themselves. They have a mind of their own, and that's a good thing. Okay, so let's see, 2 questions. So there was a question, everyone, and then there wasn't a second question. So it says, hi Scott, I am still confused about the difference between mutant and child strategies. Okay, so a child strategies is some form of a mutant from its parent. A parent had 12 ticker symbols, and the child is going to be slightly different. So that's a mutation or maybe a crossover, but in any case, the child is slightly different than the adult. And so they're a mutant and what did you say? Confused about the difference between mutant and child strategy. Yeah, child is mutated in some fashion. Another question. How did you choose bull rider, bear fighter, 8 sector percent allocations for your indices? Good question. The answer would be aggressively and yet conservatively. So if it were left up to me, well, in fact, there will be other indices that will be much more aggressive. This is kind of on the aggressive end of Middle America, and we want to try to get something that gets some decent acceptance and response. So can't go too conservative, not too wild ass. So to do that, then of course I pushed it a little bit on the aggressive end. You probably saw, and let's see if I can zoom back. Where did I have that? Right up here. Okay, so the sectors has 35% of the weight. That's more than anything else. And I think you would call that sort of pushing the more aggressive side. In fact, individual countries, the country strategy, I don't know if we can see it in here so well. Yes, here's the countries up here, and it has 26% CAGR. So, countries is more is higher performance than global regions, for example. I made the ones with the higher CAGRs have a higher percentage weight, simply because I think most of us want that. We got enough risk reduction coming out of just getting out of Dodge. We don't want to cripple the thing too badly. So if you might ask then, where did you get 8? Our experience with a lot of advisors, either directly through AlphaDroid or through our Riskalyze connection, we sometimes get a reaction where they're thinking of doing a whole client's portfolio in Merlins Magic, and then you hear, oh man, but you only got 4 ETFs. You know, I got a guy with $3 million or something like that. I can't just give him 4 ETFs. You know, I got to give him a whole pile of them, or he thinks I'm not doing my job. So with that impetus, then I went for spreading it out to be more. There's a belief by advisors that they need more diversification, so we'll have more ticker symbols, but do it in a way that we still don't hurt ourselves too much. There is a diversification algorithm that's new with these indexes that's enforced on this, whereby, for example, we've got a pair of sectors strategy. So sector strategy number 7 happens to pick I pay. When number 8 comes along and runs, it looks back at actually all of these, 1, 2, 3, 4, 5, 6, 7, and says whatever it's picked, it compares it against those guys. And if it finds that it has a duplicate of any of those guys, then it goes back to the well. You're going to be like for the financial ETFs. There's a list of alternatives. Goes back to the financial ETFs, and then evaluates, you know, if that was the one. It says, well, I can't pick this financial ETF. Maybe there's another one I can pick. So it stays within the same category, but goes back and finds the next best guy. So in the end, we do end up with 8 ETFs. Heavily weighted, in the view of some, towards the more aggressive side. There will be another index coming up very shortly, and it will have a more ordinary name called Tactical Growth and Income. And Tactical Growth and Income will be a similar combination of these. I think factors is out and global's out, and we've got more bonds, and there's a dividends one, but it's basically more weighted to the conservative end for those who want to be more snug in what they're invested in. That was the mentality there. Let's see. So everyone, back to the question. Still confused. Okay, we did that one. How did you choose? Okay, so we're coming down to what strategy was used to avoid the drawdown during the 2008-2009 crash, and what is bought during that time? Okay, so these strategies here use a different bear market strategy than any of the others. I'm not sure I published this on the bear market strategy page yet, but these guys use a bear market strategy, BMSI, and for most of the others, a BMSW, which aren't that much different, really, from the well, the BMSI is kind of like the BMSR or the BMS2, which has some ordinary treasuries and bonds in it. And except for the BMSI is allowed to go into that ticker symbol that's half gold and half treasuries. And there's I don't want to get into it right here, but you can see on the fair market strategy page why that half-breed sort of exists. So what the bear market strategy for Merlin's Magic is slightly different from these, but they have similarity. So what basically goes on, I'm going to pick this zone here. What basically goes on is usually something like IEF or corporate bonds or something comes in on here, and whenever you see a little pop in here, that's usually some kind of a treasury thing. In some of the new bear market strategies, we do put in inverse ETFs, so you can pick up some gains in this period. But for these indexes, to make them palatable to a lot of advisors, you can have nothing that's leveraged and nothing that's inversed. So these guys have nothing leveraged and nothing inversed. We will at some time, after we're done doing what we're going to do with these two indexes, then we'll get into other areas and have certainly a much more aggressive thing as well. Let's see. So what was bought? Yeah, treasuries and whatnot. Is there a YouTube video on how to create a Merlin strategies portfolio, or do we just need to rewatch this replay? Well, you could just watch this replay, or if you remember when we came down here, I think we came down to the real page. So we're going to come down to the real page here. And remember, we came to Merlyn.AI, and we came down to the Merlins Magic. And at the bottom of the Merlins Magic, tells you everything you need to know. You can click on these things. Tells you everything that I did. It's all right there. So second last pair of questions. What strategy was used to avoid the drawdown during 2002-2009? Okay, that's the same question. What was bought during that time? So one way to answer that question maybe more directly, since I was beating around the bush before, let's go to the bear market strategy page. So if we actually go over to the My Strategies page, then click on Bear Market Strategies, and we come down here, we can actually go look at these things, and let's see if it was one of the ones that was less aggressive, could have been this prudent momentum. Oh, let's see, this isn't, oh yeah, oops, I didn't mean to do that. Where do we go? There we go. I wanted to move this little chat guy here. Okay, well, maybe I can, you probably can't see the little chat guy that's on my top of my screen, but I'm going to use it as a little bit of a ruler. So in 2008, so 2008 starts right there. And let's see, maybe we can go 10 years and zoom in here a little bit. Oh, but that kind of takes off. That's starting to get back there, and we don't. This is a JPEG chart, not a JavaScript chart, so we can't slide back and forth. Okay, so 2008 comes up this line, and it looks like at the very end of 2007, I know we went in just before the end. It was orange, so it's probably TLH, and it looks like then. There certainly gets to be a light green in here, so there's HYG in there. This pop up here looks like it's actually the aggregate bond. There is a period of time where both treasuries and bonds took a sharp jump up in here. And then there was another little pop that we got right in here. Looks like it came out of junk. But you can let's see, do we have, I forget whether we have it right here or not. We don't have it right here, but you can take this this whole strategy, this BMSR, just show you how to do this. Where did it go? BMSR, there it is. Here's a strategy ID. I just copied it. Let's go over to our, I guess we have to go up here and go back over to our strategy page. And so if I come here and then paste that guy in here, we'll have our own BMSR here. And then we can maybe go down to 3 years and slide on back with this arrow here. There's 2008, and we're currently in TLH to start with, and then we go into IEF, followed by light green, HYG, some more TLH. Well, TLH actually gets us most of that pop. And then AGG, and then some more TLH. And somewhere about this time, then we get back in the market. And of course, you can actually also look at this guy right here and get your dates and do that. But you can import these guys. Okay, so where did my little notes go? See if there's any last questions here. Why did you choose to create ETFs as opposed to starting your own hedge fund? Well, now that's a very good question. Part of it was I think I can serve more interested people through an ETF. There's a lot of hedge funds out there. Hedge funds usually restrict participants to accredited investors, which means you have to have $1 million in addition to your house or a very large income. And so it puts it out of the range of most people. And so my objective here is, I'm not here to make the maximum amount of money. I'd like to survive. The subscription business isn't exactly a $1 million business. Probably there's more money in having an ETF, but a hedge fund thing just isn't going to serve the people. And I built SectorSurfer for all the people who are like various friends and relatives I had, and I just want it to be that way. And I'll answer one other question that occasionally has come to me over the years. Sometimes I give AAII presentations and people will say, somebody will stand up and say, well, you know, what's the plan in case you get hit by a bus? I need this to work for me and my boy for a long time. And okay, well, you know, we have other people and they can take over and whatnot. But the best thing that could be for even me for my retirement, or for you and your retirement, or for anybody, is to encode this in an ETF so that it has a life of its own. It now works by itself and is always there, whether I'm there or not, or anybody from my company is there. It's now enshrined in something that will be there. And for a bunch of you, you have some kind of a street account, meaning it's not in an IRA or not in a 401k. It's a taxable account. And you can buy and hold this kind of ETF that looks after the bear, looks after the bull as well, and wrap it up so that the capital gains are long-term capital gains. Now you have something better for people. So we went the route to start Merlyn.AI to go do that and to help the folks. So that's what Merlin.AI Corporation is going to do. Let's see, does the current Merlin funds include BMS? Yes, they do. Each of the Merlin funds includes one or another. Let's see, we still got more than half the people there. You might be interested in seeing where Merlin lives. So let's see, I got to move this thing out of my way here. So log off. Oh, let's see. Let's see, if I went to there, that would not be the right place. Okay, we're going to do something even more interesting. We're gonna go out on the server. See, what time is it? I want to upset nightly processing. Let's see, I got to hit this thing again here. 8:45. Oh, we're golden. So we're gonna make a direct connection. I was in Seattle, but now I'm in the lower panhandle of Florida, in a bunker underground with its own power supply, the fattest fiber optic cable connected to the internet you've ever seen, and they have their own food to last them weeks, so they say, should a big hurricane come through. That's our server down in Florida. Okay, so what we're seeing here is the server, and each line in here represents the processing of some strategy. So we have user number 136, whoever that is, doing something here, and number 6249 is on here. A couple of numbers I recognize, but I don't know who those guys are. But the first thing that happens every night is this little guy here pops up. I can safely start him here. And I can tell him to select the portfolio, which is the this guy here. So this is Merlin's Magic portfolio. He opens up, loads up all the ticker symbols and stuff that he needs. It's amazing how fast it is on the server instead of my computer. Okay, so here we see strategy 1 is bonds I, and number 2 is style box Fox, and et cetera, et cetera. And out here we have, of course, sector nectar. And in each one of these, here's where it says what goes on. So bonds I uses BMS-S. Style box Fox uses BMS-M, as does factor faves and global domination. But the sector nectar uses BMS-G. So there you have it. And so the first thing that happens every night at 9:30, after we get data, this thing pops up and runs through the portfolio number 51, which is the Merlins Magic. Then Bull Rider, Bear Fighter runs, and then Tactical Growth and Income run, and then everything else runs, starting with the bear market strategies. So, well, you might think that would be interesting. Let's make sure I get out of here without shutting something down or clicking on the wrong thing. Okay, so if I click on that, we should be able to go back. Okay, so that's all I got for tonight. I see somebody suggesting, thanks, Scott. Well, thank you all for spending your evening with me. And you will hear about where Bull Rider Bear Fighter is going in time, and it will be soon. So thank you very much. Have a good night.